This is part 2 of the series on top-down planning. And in this particular session, we're going to talk about inputs and how to negotiate the plan. So welcome back. Last week, we covered how to set the strategic frame for top-down planning. And in this episode, or this week, we are going to get tactical. How do you take inputs from functional leaders? How do you negotiate when there are gaps and you need to build consensus around a plan that is ambitious but yet achievable? So here's what I have observed over the years. The negotiation between top-down targets and bottom-up inputs is where planning either succeeds or they fail. If you're too rigid with the top-down targets, people won't commit and the plan becomes a charade everyone knows will not be achieved. But if you're too accommodating to bottom-up requests, you end up with a mediocre plan that does not move the business forward. So you need to navigate this negotiation very skillfully. You need to balance firmness on strategic goals with flexibility on how to achieve them. So let me walk you through the process that actually works. Step 1, get the bottom-up inputs in a structured format. Don't let functional leaders submit whatever they want. Give them a template. And that ensures you get comparable, analyzable inputs. And here's what I ask each functional leader to provide. What is your current baseline? What is your current performance and run rate? What are the proposed targets? What do you think you can achieve next year? And we look at the gap to top-down target. How does your proposal, how does it compare to what is required? What are your resource requirements? How much headcount are we talking about? What are your budget expectations? How much investments do you need? And then define the key assumptions. What are you assuming? What are you assuming about productivity, about conversion rates, about market conditions? What are the underlying assumptions that are driving you to think the way you do? What are the key risks? What could prevent you from hitting these targets? This structured format lets you compare inputs across functions and identify where the gaps are and where the issues are. Then step 2, look at the gap and analyze them systematically. Once you have the inputs, map them against the top-down targets. Where are the gaps? Are they in revenue growth? Are they in margin expansion? Are they in expense management? Are they a combination of all three? So observe that gaps, they usually fall into a few categories. There is, of course, a capacity gap. We don't have enough sales reps to hit the bookings target. There could be a productivity gap. Our current conversion rates or deal sizes won't get us there. There could be investment gaps. We need more budget for marketing. We need more budget for product and infrastructure. And then there could be timing gaps. We cannot hit the annual target, but we can hit the annual target, but the quarterly phasing is at risk. So categorizing the gaps helps you understand what you're really negotiating. Is this about resources? Is this about operational improvement? Or are we talking about timing and risk tolerance that we need to figure out? The step 3 then is to really pressure test the bottom-up assumptions. Don't just accept the functional inputs at face value. Dig into the assumptions and challenge them constructively. And here's how I do this with the head of sales. Okay, so you're projecting you need 25 new reps that will generate another $18 million in revenue, in ARR. There's 600K per rep or more, but our historical average is 450K per rep. What is different that will drive a higher productivity? Are you assuming better rep quality? Better territories, better product market fit? What's going on? And if they have good answers backed by data, awesome. That's great. Take it. If they are being too optimistic, which is what sales sometimes do, push back. I need to see the plan for how we'll achieve above historical productivity before I can even start modeling this. Otherwise, let's plan with our historical averages and figure out if we need more reps or if we need to find productivity improvements elsewhere. So you go at it from different angles, and this pressure testing is not about being difficult. It's about building that rigorous plan based on realistic assumptions. You move the thinking to step 4. You model the various scenarios. When there's a gap between top-down targets and bottom-up inputs, don't just argue about it. Model the different scenarios together and evaluate the trade-offs. Here's what this looks like. We have a $5 million gap between the top-down revenue target and what sales thinks that they can deliver. So now let's model the 3 scenarios. This scenario A, let's say, and we hired 10 more reps beyond what sales proposed. So now that costs an additional $2.5 million, and it extends our cash runway. It doesn't extend it actually. There's a risk to it. We look at the average deal size. Is the deal size getting better? What do we need on the product investment? without making any additional hires. We pursue the enterprise segment more aggressively, which has higher deal size but longer sales cycle and might create Q1, Q2 risk. You look at all of these different inputs that you're getting and you model these various scenarios. Look at the P&L impact, look at the cash flow impact, assess the risk. And now you're having a strategic conversation about how to close the gap rather than arguing about whether the gap exists. Find the operational improvements that are hidden in the plan. I've observed that most bottom-up plans, they assume current performance and they assume the current level of productivity will continue, but there's almost always opportunity to improve performance through better processes, tools, or focus. So the question that the CFO needs to ask, where are we underperforming to our potential? Can we possibly improve our conversion rates, your productivity or efficiency? What operational improvements could perhaps close part of the gap without requiring more headcount, more resources? Let me give you an example. We had a gap between sales, which was a bottom-up plan, and the top-down target. But instead of just arguing about hiring more reps, you know what we did? We analyzed the sales funnel. We found that the lead to opportunity conversion was 15%. But our best reps had a lead to opportunity conversion of 22%. That makes a difference. We found that the average sales cycle was 94 days, but our best reps were doing it in 68 days. So we built a plan. Implement better sales enablement, focus on higher probability segments, improve lead quality through marketing alignment, create a learning organization at that point, learning from best practices from the better reps. If we could move the broader team toward the performance of our best reps, we could perhaps close 40% of the gap without hiring a single additional person. And sales bought into this plan because why? Because it was based on what was already being achieved internally, not some external benchmark that felt irrelevant. Negotiate the investment and accountability together. When function leaders, they ask for resources to hit ambitious targets, create explicit accountability. And how do you frame this? Sales. You're asking for 30 reps and $8 million in budget to deliver $25 million in new ARR. I'll support that investment if you commit to quarterly milestones and agree that if you are not tracking to plan by end of Q2, we will reassess the hiring plan. Is that fair? Or you go to marketing and you say, marketing, you want to increase budget by 60% to drive the required pipeline. Fine. I'll approve that if we implement rigorous ROI tracking by channel and agree to reallocate the budget quarterly away from marketing if it's underperforming against the milestones that you set our expectations. Is that a deal? So what you're actually saying is that you're saying yes to the investment, but you're creating accountability for results and flexibility to course correct if assumptions are proving wrong. Use a CEO to break ties and drive the alignment. Sometimes after all the negotiation, you still have gaps or disagreements. And that's when you need the CEO to make the call. I do this by presenting the CEO with clear choices. We have negotiated the plan extensively. We are down to 2 remaining gaps. The first one around sales, they want $8 million in investment to deliver $25 million in new bookings. And finance thinks that we can achieve $23 million with $6.5 million investment and a few operational improvements. Second, the product wants to hire 12 engineers and finance thinks we can achieve our roadmap with 9 engineers and better prioritization. So CEO, which way do you want to lean on these trade-offs? Frame it as strategic choices, not as CFO versus functional leaders. Let the CEO make the call. You provide the support. Let the CEO commit to the decision, and then once that decision is committed to, then you execute, you move forward. Let me share you what a successful planning negotiation would look like. You start with a significant gap, maybe 30 to 40% between top-down targets and bottom-up commitments. And then through structured negotiation, you start closing that gap to 10 to 15%. You find operational improvements that get you part of the way. You agree on targeted investments that get you more of the way. And you accept some reasonable level of stretch in the final plan. Maybe 10% stretch is healthy. Maybe 15% if market conditions are strong. And then the final plan is ambitious, but the team now, they believe it is achievable. They have been heard. Their concerns have been addressed. The resources now will be committed or have been committed, and they're accountable for that execution. I've observed that when you run this process well, you get 3 critical outcomes. And you know what they are? 1, a more ambitious plan than pure bottom-up would produce. 2, a more realistic plan than forced top-down performance would demand. And 3, there's a genuine commitment from the leadership team because they have been partners in building the plan. They're not victims of targets imposed upon them from the top. So the next session, in a final part, I'll show you how to make the planning process successful. We'll talk about governance, we'll talk about timeline, and how to avoid those common pitfalls, and how to ensure that the plan actually drives execution once it is approved. I look forward to seeing you in part 3. Take care. Bye-bye.